Let's move on to standard number 3, duties to clients. So standard 3A discusses loyalty, prudence, and care. Members and candidates have a duty of loyalty to their clients and must act with reasonable care and exercise prudent judgment. Members and candidates must act for the benefit of their clients and place the client's interest before the employer's or their own interests. So let's just talk about this very briefly. Duty of loyalty. That means your obligation is first and foremost to your client, not to your employer and not to yourself, but to take care of the interest of your clients. And what is expected is that you'll use reasonable care. Okay, that you'll do your due diligence, that you'll act in a professional manner, and that you'll exercise prudent judgment. So let's look at the definitions. Loyalty, act in the best interest of your client. Prudence, act with the care, skill, and diligence of a reasonable person. And then act prudently and judiciously to avoid harm to your clients. Okay, so those are the expectations that we have as professionals. So standard 3A sets a minimum expectations of conduct. And the minimum expectations of conduct is dictated largely by the job function, the relationship with the client, and the nature of services. So 3A gives us a general benchmark around loyalty, prudence, and care. But that's to be distinguished from fiduciary responsibility. So fiduciary responsibility is a higher standard of care. Often there are laws or regulations that dictate what a fiduciary needs to do with regard to his or her clients. Section 3A doesn't really deal with the issue of being a fiduciary. But that said, it does encompass loyalty, prudence, and care. And we always must work in the best interest of our clients. The first step we have to do is to identify the client. So in the case of an individual, it's very clear who the client is and who we owe loyalty, prudence, and care. But let's take a pension plan or a trust. If we're managing a pension plan or a trust, loyalty, prudence, and care is owed not to the person who hired us, but to the beneficiaries of that pension plan or trust. Let's say, on the other hand, you're managing an investment fund that is tied to an index. Then in that case, what your obligation is to manage to the expectations of, or the mandate of, that index. And the individuals who have relationships with each of the clients owe them a loyalty, prudence, and care. So when we think about individual clients, we want to think about how we exercise this loyalty, prudence, and care. So first, we have to think about the investment objective and expectations. Are they reasonable? So what does the person want? Are they reasonable? And if they're not, we have to guide them in a manner that is more reasonable. So if a client comes to you and says, I want a 20% return on investment over the next 5 years, that may not be a reasonable expectation. So we have to make sure that we educate the client and that his or her investment objectives are reasonable. We also have to make sure that the investments are suitable, the risk is appropriate. So as people age in the workplace, then we tend to recommend that they take some of the money and put it into more secure investments such as bonds or treasury notes, and less in the stock market. So we have to make sure that we are guiding the client to have a portfolio that's in his or her best interest and the risk is appropriate. So again, we're always acting in the best interest of our client and trying to help them achieve their investment objectives. And when we're doing that, we're not talking about individual investments, we're looking at their entire portfolio. So we may find that some things are exceeding expectations, some things are below, But if their entire portfolio is moving towards their investment objectives and expectations, then we can be satisfied that we are exercising our responsibilities in an appropriate fashion. So let's talk about some examples of loyalty in practice. So one thing that is prohibited by Standard 3A is this idea of soft dollars. That is charging an excessive commission or charging an extra fee for something that does not add value to the client. The other expectation is that when we execute transactions for the client, it'll be in the most economical and efficient manner to help achieve their objectives and goals. So we don't execute things that may reward us with a higher commission or may not be as efficient as could be expected. The other thing that comes into play is this idea of proxy voting. So many times clients will allow the investment advisor to vote on proxies that their holdings are issuing. So our obligation is to do our due diligence and to vote in compliance with what our client wants. So it's not enough just to vote with management. That would be a violation of Standard 3A. We have to think about what's in the best interest of our client, what are our client's objectives, and vote accordingly. All right, here's an example of something that's totally unacceptable under the standards, right? Okay, which essentially is an advisor who is doing trades so that he or she can earn additional commissions on the trades. And here's another example. They manage the portfolio of, oh, I'm sorry, that's a repeat. Okay, here it is. So the chief investment officer of a medium-sized money management firm is concerned about retaining a client that accounts for almost half of his revenue. The client recently told Preston that if the performance of her account did not improve, she would find a new money manager. Shortly thereafter, Preston sorry about that. So when we're dealing with fair dealing, we have to always put our client's interests first. So in any case, Preston purchases money back for several accounts, but does not allocate the trades immediately. He later realized that some of the has significantly increased in price and some have dropped. He allocates the profitable trades to his large, unhappy clients and spreads the losing trades among several other clients. Okay, so again, it's clear that this is unacceptable. But also the thing to keep in mind is the temptation, right? So we need to avoid these temptations, right? We need to comply with the standards. Okay, so let's talk about standard 3C, suitability. When members and clients are in an advisory relationship with the client, they must A, make reasonable inquiry into the client or prospective client's investment experience, risk, and return objectives and financial constraints prior to making any investment recommendations or actions, and must reassess and update this information regularly. Okay, so it's not enough just for you to do what you think is best. You need to talk to your client so you understand what they know about what you're going to do on their behalf, and you need to stay informed on that. And then determine that an investment is suitable to the client's financial situation and consistent with the client's objectives, mandates, and constraints before making an investment recommendation or taking investment action. So if somebody's younger and wants to be a little more aggressive, you might have one portfolio recommendations. If somebody's closer to retirement, then you should have a significantly different set of portfolios that you would offer to your client. But the main thing, as is the case throughout Standard 3, is that we want to keep the best interest of our clients forefront. So when members and candidates are responsible for managing a portfolio to a specific mandate, strategy, or style, they must make only investment recommendations or take only investment actions that are consistent with the stated objectives and constraints of the portfolio. So that is, you can't step outside and on speculation on the hope that you can do something that would exceed the expectations. You must stay within the mandate that the client So if the client says to you, I only want treasury notes, or I only want bonds, and you see an opportunity to make some extra money for your client, that's not appropriate. So in an advisory relationship, to judge suitability, evaluate the client's knowledge, experience, and financial circumstances, the risk profile of the investment versus the client's risk tolerance. So we expect risk tolerance to go down as one approaches retirement age, and the impact on the portfolio. But responsible for assessing the suitability only on the basis of information actually provided by the client. Client risk tolerance. Monitor rapidly changing investment environments, and certainly we've been living through that most recently. Analyze and quantify risk of the investment in advance. Evaluate use of leverage, ways that you can mitigate risk or leverage it, and then diversify. So we think about suitability. And effective investment policy, IPS, gathers relevant information on a client's financial circumstances, personal data, investment objectives, risk tolerance, investment return requirements, time horizon to when they're going to retire and need the money, any short-term liquidity needs, tax concerns, legal and regulatory factors, and other unique circumstances. So you can see there's a lot that goes on here that we have responsibility for to ensure that we comply with standards. So this whole issue requires a high level of professional engagement and interaction. So it should also identify and describe roles and responsibilities, include schedule for review and evaluation with the client, guide development of an appropriate strategic asset allocation investment program, and you should update it at least annually, if in most cases more frequently, particularly during times of volatility as we've been living through, and reflect the changing nature of the portfolio and the client's characteristics. So as things change, we need to make adjustments, right? And that could be either the portfolio or the client. Unsuitable investment requests by the client should discuss the concern with the client, have client acknowledge unsuitability of the investment, and update the IPS if necessary. So if the client says, hey, I've got a great stock tip here, and I want you to invest 50% of my portfolio, and you don't think that's in line with his or her investment portfolio, then you need to have a frank conversation with your client. Now, at the end of the day, if the client dictates that you do that, then you have to make sure that you documented that you've expressed your concern with your client, and then update the IPS as appropriate. If the investment professional is investing to a mandate, for example, if you're investing to a mandate of a large cap, then your obligation is to be consistent with the mandate. So for example, it would be inappropriate for you to invest in startup companies or small cap funds. The other thing to keep in mind is that if you're not required to determine the suitability of the mandate for particular investors, the individuals who invest in that particular fund, the obligation resides with their investment professionals. So your obligation is to be consistent with the mandate of the fund. All right, let's look at a couple of the case studies under suitability. So Mate is an asset manager in Puerto Rico, a U.S. territory. Puerto Rico residents receive significant tax advantages by investing in local securities. To capitalize on this advantage, Mate's firm offers clients in a closed-end investment fund organized under Puerto Rico financial laws and regulation that holds at least 67% local securities and is permitted to borrow up to 50% of its assets. The fund is usually leveraged to the extent legally permitted. Many of Mate's clients with modest net worth and conservative or modest investment objectives invest 85% or more of their accounts assets in the fund shares. Mate's actions are inappropriate because the investment is unduly risky for his clients. Okay, so I'm going to allow you to read through the other study here. case study, and then we'll move on to section D, which is performance presentation. Okay, so under section D, when communicating investment performance, members and candidates must make reasonable effort to ensure it's fair, accurate, and complete. So it mandates credible presentation of investment performance history, prohibits misleading statements, encourages full disclosure, applies to statements about future expected performance, applies whenever you claim responsibility for performance history. Cannot predict future returns based on past success. Research analysts must be truthful about the success or accuracy of their reports. So you can't not include some information that you may not deem to be favorable. You have to put your entire information deck on the table. Questionable performance reporting practices, presenting just a representative account, using simulated results, eliminating terminated accounts, misidentifying historical performance records, and using inappropriate benchmarks. So complying with the CFA Institute Global Investment Performance Standards are known as GIPS. So GIPS is recognized internationally, and it guides investment professionals as in providing accurate and consistent performance information. Comparable histories requires investment professionals to collect similar accounts and make them into a composite. And to say you're in compliance with GIP, you have to meet all of the requirements. So I'd strongly recommend that you at some point take some time to get your hands on this Global Investment Performance Standard Handbook. It's available for free at their website, and that really is the international standard. So there's a couple of case studies here in section D. I'm going to let you read through these yourself and make some assessments in terms of why the answers are what they are. Okay, so at this point, we're going to move on to the last section of Standard 3, which is Part E, preservation of confidentiality. So members and candidates must keep information about current, former, and prospective clients confidential unless they're involved in illegal activities or the law requires it. The client or prospective client, or the client or prospective client permits disclosure of the information. So generally speaking, we're going to keep all information confidential unless one of these three criteria is achieved: illegal activities required by law, or it's permitted in writing by the client or prospective client. So one thing we have to be particularly careful about is the abundance of information that's stored electronically now, and knowing that that's susceptible to accidental disclosures. So we really have to encourage our employer, or we have to ourselves implement policy and procedures that will safeguard the information both from accidental release and or other employees or others gaining access to the information. Very important that we do our best to safeguard all the information. So if the CFA Institute's professional conduct has an investigation, you're required as a CFA member or candidate to comply and provide the information requested. Okay, there's a couple of case studies here that I'm going to let you read through on the preservation of confidentiality. All right, so that concludes our discussion on Standard 3. At this point, if you could please do the graded assignments, which you may take multiple times, and then participate in the week 2 discussion board assignments. Thank you so much, and I look forward to hearing from each of you.